Welcome to this lesson on the time value of money, or TVM. This is a foundational and important concept in finance that helps us understand how money grows, how timing affects the value of money, and how businesses and people use this principle to make smart financial decisions. Let's jump right into it. The time value of money is a basic financial concept that money in the present is worth more than the same amount of money to be received in the future. The core idea behind TVM is that money has earning potential. If you receive money today, you can invest it and earn interest on it. But if you wait to receive it later, you lose the opportunity to grow it. That's why time affects the value of money. Time matters in finance for three big reasons. First, money has earning power and can be invested to grow. If you put $100 in the bank at 5% interest, in 1 year, it grows to $105. Secondly, inflation erodes value. Prices rise over time, so $100 next year won't buy as much as $100 today. And third, there's always a risk you might not receive future payments. Money in hand today is guaranteed, but a promise of money in the future always carries some risk. That's why we prefer to receive money sooner rather than later. As an illustration, let's say for a promise to receive $100, you're faced with these two options, to either receive $100 today or wait for 1 year to receive $100. And let's assume the bank pays interest at 5%. How would you analyze and evaluate these two options? Let's take a look. In the first option, if you receive $100 today, you could put it in the bank, invest it, or even lend it out. Over 1 year, the money grows at 5% to become $105 at the end of the year. Now let's look at option 2. With this option, you only get $100 1 year from now. So this simple illustration shows why $100 today is worth more than $100 in the future. The difference in value between money today and money in the future is the time value of money. Let's explore how the time value of money is applied in the real world, both for individuals and businesses. In the business world, TVM plays a critical role in decision-making. For example, when companies assess new projects, they calculate the net present value of future cash flows. Similarly, when a company is deciding whether to lease or buy equipment, it uses TVM to compare the long-term cost of each option. It also helps in valuing target companies in mergers and for planning future capital needs. On the personal finance side, when you save for retirement, financial planners use time value of money to estimate how much you need to invest now to meet your future lifestyle goals. When you take a mortgage, car, or student loan, the bank uses amortization, based on time value of money, to calculate your fixed monthly payments. To pick the best stock or choose between stocks or bonds based on future returns, TVM is just as important. Whether it's personal finance or business strategy, understanding the time value of money helps people make smarter financial choices today that pay off tomorrow. There are 5 key building blocks that make time value of money work, and they are interest rate, time or number of periods, cash flows, present value, and future value. These elements together explain how money changes in value over time depending on when it's received, how long it's invested, the rate at which it grows or shrinks, and how we measure its worth today versus tomorrow. Let's take a closer look at each one of these elements. The interest rate is the engine behind time value of money. It is the cost of borrowing money or the reward for saving money. It is also called a discount rate or the rate of return. It is expressed as a percentage and determines how fast money grows or shrinks. Higher rates mean faster growth in future value and a lower present value for future cash. It's key in comparing financial alternatives. The number of periods is simply how long money is invested, saved, or borrowed, and it tells us how long your money is at work. More time usually means more growth, but also more exposure to risk or inflation. So, period count affects how we calculate present and future values. It can be measured in years, months, quarters, or even semi-annual periods or days. It impacts both present and future values. And more periods mean more time for interest to accumulate or impact value. Cash flows or payments. Cash flows are payments or receipts that occur over time. Cash flows are the actual amounts of money coming in or going out over time. They could be things like expenses paid out, income or proceeds from investments, and even loan payments. Time value of money is used to evaluate the value of cash flows depending on when they occur. The timing matters. A $1,000 inflow today isn't the same as $1,000 5 years from now. That's why time value of money is so important. Present value. Present value tells us what future money is worth today. It helps answer questions like, how much should I pay today for a future $1,000? It adjusts future cash for timing and interest rate, giving us a grounded value to work with today. It is today's value of money you will receive or pay at a time in future. It helps us to compare future cash flows to current costs or investments. For example, if you're promised $1,000 in 1 year, its present value or today's value might be a little less than that, depending on the interest rate. A single period timeline for a single lump sum cash flow would look like this. And present value would be calculated as future value divided by, open parentheses, 1 plus the interest rate, close parentheses, to the power of the number of periods. Future value. Future value tells us how much today's money will be worth at a future date after it has earned interest or investment returns. Future value of an investment value is expressed it in terms of dollars in the future. You may want to know the future value of a present amount. For example, if I deposit $8,000 today in the bank at a specified fixed rate, how much will I have in my account when I retire in 20 years? It is the value in the future of money you have today after interest builds over time. It is what today's money will be worth later in future. Future value lets us project how money grows. Whether saving for retirement or evaluating a business project, future value tells us what to expect if our money is working over time. A single period timeline for a single lump sum cash flow would look like this. And future value would be calculated as present value times, open parentheses, 1 plus the interest rate, close parentheses, raised to the power of the number of periods. These two equations and timelines for present and future values apply to a single lump sum cash flow type. There are other types of cash flows, which we will cover in other lessons, like streams of unequal cash flows, annuities, perpetuities, and others, and their calculations of present or future values all have different formulas or methods. Depending on the type of cash flow or structure of the payments, one or more of these elements may not always be present in every scenario. A quick example is a perpetuity, which is a stream of cash flows that continue forever with no end date, and no end date means there is no future value in the formula for a perpetuity. To recap, in this video, we introduced the concept of time value of money, explored real-world applications, and learned about the building blocks or core elements of time value of money. Other topics in this series include types of cash flows, interest rates, solving problems on time value of money, and practice problems. Subscribe to this channel and visit our website for more.
For more videos like this and other learning resources, subscribe to our channels. And if you need tutoring help on this topic, visit our website at www.kedemics.com to book a session. See you next time.